S&P 500 futures are down 0.5% right now, and Nasdaq 100 futures are sliding a full 1.1% in the overnight session. The implied open is looking incredibly heavy, and the opening bell hasn't even rung yet.
Yeah, it's a brutal setup this Friday morning, June 5th, 2026. Yesterday, we were looking at record highs, and today, buyers are just completely on strike.
Right, and that's exactly why today's deep dive is pulling straight from an institutional strategy briefing that just hit the desks this morning. Our mission here is to unpack this massive structural rotation happening under the hood. We've got a collision of tech fatigue, a highly anxious macro environment, and some serious geopolitical headlines.
Exactly, because if you're just looking at the top-line indices, you might think it's a standard dip. But the pre-market volume tells a totally different story. We're in this massive pre-macro volume vacuum right now.
Yeah, everyone is just paralyzed, waiting for 8:30 a.m. Eastern.
Right. The May Nonfarm Payrolls report, that is the ultimate catalyst today.
And the street is bracing for, what, 85K to 105K jobs added, which is a decent step down from April's 115K.
It is. And they're expecting the unemployment rate to hold steady right around 4.3%. But the stakes on this specific print are just astronomically high.
Because it's a tightrope for the Fed, right?
Absolutely. The Fed wants optionality. But if this NFP print comes in hot, say, well above that 105K consensus,
then the higher for longer fears come roaring right back.
instantly, the market will aggressively reprice the terminal rate. But, on the flip side, if we get an ice-cold print, maybe under 50K.
It's not a rate cut celebration anymore. It's a full-blown growth scare.
Exactly. Wall Street used to buy bad news because it meant liquidity. Now, bad news just means we're staring down an earnings recession.
Trapped between inflation and recession. But we also have to factor in the geopolitical wildcard this morning. The briefing specifically calls out the headline risk, with former President Trump stating he'd consider meeting Iran's supreme leader under a highly fragile ceasefire.
Right, and the timing on that is,
Well,
it's volatile.
and just to be crystal clear for you listening, as we unpack this, we are strictly reporting the data from the institutional sources here.
Yeah.
We're not endorsing any political viewpoints, just analyzing the raw geopolitical landscape and how the desks are pricing it.
Which is entirely through the energy markets. I mean, institutional money doesn't trade the politics. They trade the oil supply risk.
Right, and we're seeing WTI hovering near $91 a barrel, and Brent is pushing near 95.
Yeah, and when crude is that elevated and volatile, it puts a firm lid on any pure risk-on sentiment. Institutional managers aren't going to chase high beta tech when a Middle East supply shock is a very real possibility going into the weekend.
Makes total sense. So let's look at the mechanical trap this creates, because the strategy briefing highlighted a stat that honestly made me do a double take. Citigroup's U.S. bear market checklist just triggered 11.5 out of 18 flags.
Which is the frostiest level since the GFC. It's highly concerning.
Since the global financial crisis. So we're basically sitting in a crowded theater, everyone's eyeing the exits, but nobody wants to be the first one to dump their shares, right?
Nobody wants to miss out if the NFP print is the Goldilocks scenario. But the risk asymmetry is terrible.
But retail always buys the dip in tech, right? That's been the playbook for 18 months. Why is today any different?
Because of the 10-year Treasury yield, right now it's sitting at 4.47%. The briefing maps out what they call the institutional pain trade. If the jobs data is hot and that 10-year yield spikes back toward its recent high of 4.67%.
We get what the briefing calls the high beta valuation guillotine.
Yeah, that's phase one. Retail has treated AI infrastructure and semiconductors like defensive assets, but they are high beta. If the risk-free rate spikes, the discount rate on those future earnings mathematically compresses the multiples.
And then the CTA trend-following funds step in.
Milliseconds later, the algorithms don't care about the AI narrative. They just read the momentum and the yield spread. They will trigger massive, indiscriminate sell programs.
Wow. Okay, so tech gets crushed. But usually, money flees to treasuries. But phase two of this pain trade is the treasury capitulation squeeze.
Right, because retail bond bulls are already offside. They've been piling into long-duration treasury ETFs, front-running the idea that incoming Fed Chair Kevin Warsh is going to slash rates.
So if the 10-year yield goes up instead,
those long-duration bets get decimated. They'll be forced to capitulate, dumping bonds at a loss just to stop the bleeding.
which pushes the yield even higher.
Exactly. It's a feedback loop that fuels the valuation guillotine.
Brutal. And that leads to the third phase, the cruel rotation trap. Because the money doesn't just evaporate, right? It rotates.
Money never sleeps. The capital fleeing high multiple tech and long duration bonds is going to instantly rotate into short duration cash flow plays.
So the S&P looks fine, the Dow looks green, but retail portfolios heavy in tech are just bleeding out.
Deceptively stable at the index level, yeah, it's a total trap.
And we actually saw this valuation guillotine drop yesterday on Broadcom, ticker AVGO. Broadcom plummeted 12.6% yesterday, and it's still bleeding in the pre-market.
Yeah, that was a shocking move for a lot of people.
Right, because on paper, it looked great. They beat Q2 revenue, $22.18 billion. EPS was 2.44, another beat, and yet 13% wiped out. Why?
The AI space is priced for absolute perfection right now. The beat on Q2 is backward-looking. The algorithms only care about the forward guide, and their Q3 AI revenue guide was $16 billion.
Which missed the whisper number. The briefing specifically noted the street was whispering $17.2 billion.
Precisely. If you miss the underlying euphoric whisper number by $1.2 billion, you get punished. And then Hawk 10 confirmed they aren't shipping any more custom AI racks to Anthropic.
Oh man, so a major future growth vector just vanishes.
Yeah, and the momentum algorithms just dumped it. It triggered a global rout. I mean, we saw the KOSPI down 5.1% overnight, largely off the semiconductor panic. For Broadcom today, the bulls have to reclaim that 435 to 437 zone.
And if they don't?
The bear case sees a flush down to 400 or 408.
Okay, let's look at another tech casualty today that highlights the zero-tolerance market. DocuSign, ticker DOCU. Down almost 5% pre-market, sitting right around 48.85.
Another classic execution risk punishment.
Right. They beat EPS at $1.09. They beat revenue at $830.2 million. They have $1 billion in cash. They're doing record buybacks. And they highlighted their new AI-native intelligent agreement management platform. It sounds bulletproof.
It sounds great until you look at the Q2 revenue guidance, $865 to $869 million. That barely nudged past the $866 million consensus.
So it's the exact same story as Broadcom. No blowout guide, no premium multiple.
Exactly. The market is saying, okay, you're calling yourself AI native now. Where is the exponential AI growth? Because transitioning from an e-signature company to a full AI platform carries massive execution risk.
And with $1 billion in cash, buyers still don't care. They're just hitting the bid.
They're rotating out.
It's not just tech, though. The briefing shows the consumer is also cracking. Look at Lululemon, ticker LULU, down 11.8% pre-market, totally blowing through its 52-week low, down to around 110.8.
That chart is incredibly broken this morning.
Q1 revenue was $2.5 billion, which was technically a beat. But the internals, 410 basis points of margin contraction.
410 basis points is a disaster for a premium apparel brand. They are heavily discounting in their "we made too much" channel just to clear inventory.
Which destroys the premium pricing illusion, and North American traffic dropped 5%. Plus, still no permanent CEO.
Right. And you look at the strategy brief, they literally downgraded LULU to a deep value turnaround play. For a former high flyer, that's the kiss of death.
The brief says if it loses 110 today, there's a trapdoor straight down to the 100 psychological level.
And I wouldn't step in front of that train.
So we've got AVGO bleeding, DOCU failing the AI test, and LULU cracking on consumer weakness. The money's rotating somewhere. Where's the smart money hiding out today?
Financials and defensive value. Pure and simple. Just look at the tape from yesterday. While tech was getting taken to the woodshed, the Dow Jones ripped 1.7% to absolute record highs.
Led by the megabanks. JP Chase was up 3.3%, Goldman Sachs up 4.9%.
And BlackRock surged 3.02%, and by the way, they go ex-dividend today, so keep an eye on that.
Ah, good flag. But yeah, this is the cruel rotation trap right in front of us.
It is. A sticky 10-year yield and a surging U.S. dollar driven by that Middle East safe haven demand. That's toxic for tech multiples, but it's pure margin expansion for the big banks. Institutions are hiding in JP and Goldman, collecting the yield and waiting out the storm.
Let's bring all this macro anxiety down to the actual execution levels. The briefing gives us the exact lines in the sand for today's session. Let's start with the S&P 500 futures. Pre-market, we're floating around 7,557. Where's the key zone?
The absolute line in the sand today is 7,535 to 7,535. That's a structural floor that buyers have defended for 2 weeks.
And if the NFP comes in hot and we slice through 7,525?
If we lose that, we enter a liquidity vacuum. The systematic selling will kick in, and we're looking at a swift liquidation down to 7,500.
And if 7,500 fails to hold?
Panic. Total panic. Down to the major macro shelf at 7,330.
Wow. Okay, what about the tech-heavy Nasdaq 100? Pre-market is around 30,224.
The Nasdaq is even more precarious. The critical support is 29,744.
And if that 29,744 floor gives way?
It's a gap and go to the downside. The next real algorithmic target is all the way down at 29,290.
So, synthesizing all of this, the NFP tightrope, the geopolitical oil risk, the valuation guillotine, what is the ultimate verdict from the strategy desk? How are they telling active traders to handle the open today?
The mandate is strictly defensive. Do not chase pre-market green. Keep your leverage incredibly light. The algorithms are just waiting to trap early liquidity.
So sit on your hands for the first 30 minutes.
Exactly. Let the cash session open, let the initial knee-jerk reaction to the payroll data play out, and see if those floors, 7,525 on the S&P and 29,744 on the Nasdaq, actually hold under live selling pressures.
And if they do hold,
then you can cautiously buy the dip. But if they break, step completely aside. Let the machines fight it out on the way down.
it's going to be a wild Friday. To recap this deep dive, we are sitting at an incredibly fragile intersection. The labor market is going to dictate the Fed's reality in a matter of minutes. Geopolitical friction in the Middle East is capping risk appetite via oil. And we have an aggressive, algorithm-driven guillotine waiting to execute any tech stock that misses its whisper numbers.
And that institutional rotation into the big banks is creating a deceptive surface stability that could really trap retail today.
Absolutely. Which brings us to a final provocative thought to leave you with from the briefing. We're looking at a market where systematic funds instantly punish any slight imperfection in tech execution. But if the machines are dumping shares based on slight AI whisper misses, are human investors better off just hiding in defensive value like the banks?
Or, and this is the real question, does this emotionless algorithmic panic actually create the best long-term buying opportunity of the decade for humans willing to stomach the volatility?
It's the ultimate man versus machine setup. Can you look past a single quarter's guidance while the CTA funds panic sell? Keep your eyes on those lines in the sand, manage your risk tightly, and trade safe today.